So my name's Elisa David. I'm a partner at Norton Rose Fulbright, which is a global law firm. I lead the Australian climate change and sustainability practice on behalf of the firm. And I'm delighted to be moderating this session here for IGCC today. So the theme of this discussion is really to explore what the transition across the economy is going to look like, how transition risk is being considered from different perspectives, from those on the panel, but also their perspectives on the broader corporate world and where that is sitting in terms of evaluating the transition risk. But one of the key things that we do want to explore in this session is also where those opportunities lie and those companies that are starting to position or looking at what that transition is going to offer in terms of economic growth and associated opportunity. So the first thing I thought I would kick off is just a general question to the panel about, from their perspective, from within their own organisations, what they're doing to assess, consider and manage transition risk. So Artie, if you'd like to kick off.
Sure. Thanks. So for us at the Super Fund, the way we've managed transition is across our investment portfolio, and the way we've implemented this is through our climate change investment strategy. So this was a strategy that we launched back in 2016, and the core objective of our strategy was to ensure that we make the portfolio a lot more resilient to climate change risks. And in the design of this, we had kind of two high-level principles. The first was to ensure that the strategy is applied at the whole of portfolio level. And the second was that in the way we implement it, we make sure that it's consistently applied across all our investment strategies. So the climate change investment strategy has 4 core pillars. The first is to reduce our carbon exposure. The second is to analyse and look at how we price the risks of carbon in our investments. The third is engage, so engaging with our portfolio companies that we've heard a lot about already in the last couple of days. And then the third is search, so searching for new investment opportunities in the whole clean green space. And the transition aspect was probably quite uniquely placed in the way we've reduced our exposure to carbon in the portfolio. And this has been applied in our passive equities portfolio. And so what we've done essentially is just pretty much reduce our exposure to those companies that have high carbon intensity and those that own fossil fuel reserves. But what we've done is we've retained in the portfolio those companies that are also part of the solution. So companies that might essentially have high emissions, but they're also themselves are in their transition journey, we've left those in the portfolio. So yeah.
And I've been very remiss because I didn't introduce my panellists, so I'll just do that before I hand over to Rosemary. Apologies for that. So Artie Prasad, who is the Senior Investment Strategist of Responsible Investment at the New Zealand Super Fund, so obviously comes to us from that New Zealand perspective. Rosemary Bissett, who is Head of Sustainability Governance and Risk at NAB. And Brian Cahill, who is the Managing Director at Moody's, so apologies for that. Rosemary, your perspectives on transitional risk from NAB's point of view.
Okay, well, to get started, we just started with, I guess, very, very high level semi-qualitative risk mapping. So it was using our experts internally because as a bank we're across the economy and we have, for the different customers we're serving in different sectors, expertise within the bank around those sectors. So we started pulling that together and we used the Bank of England's model. They put in liability risk as an additional risk rather than keeping it inside transition risk. And we were curious around the shifting liability landscape. So we wanted to have that separate, and we do monitor that. And then we essentially went right across the bank looking at physical transition and liability risk and ranked the sectors that we bank high, medium and low. And then that's given us what we've then used to take into more detailed transition risk analysis or physical risk analysis and scenarios. Unlike sort of an investor, we think we need to look at this sector by sector and actually understand the strategies of our customers. So in the work that we've done to date, it's absolutely getting customer by customer understanding of what they're doing, what their strategies are, how they're responding to TCFD, whether they're doing scenario analysis, and looking at the trajectories that they have for 2 degree and 1.5 degree, etc. And then using that alongside the science and the scenarios. So we've participated in the UNIPEFI TCFD pilot, which in that we had a very high level look at mining and metals and energy, some of the most carbon intensive and sectors. So we started there, but we've also looking at transition risk for low carbon as well. So where you understand there's risk for some sectors and they might have a decline or a sunset clause on them, then you'll also see opportunities for emerging sectors. And it's a double-sided coin. So utilising the risk information to understand what the opportunities are and having a conversation internally, that's quite helpful, because if you're going to say you can't do something anymore, it's absolutely empowering if you can turn around and say, but here is where the opportunities are, this is where we need to skill up, this is what we need to do. And you know, you've seen the rise of products like green bonds, sustainability-linked loans, and we have a green term deposit as well from UBank, which is absolutely getting received well in terms of people's demand for product to help them do things or ensure their money's going to help the transition. So in the TCFD pilot, it was an opportunity to experiment with 16 other banks on the methodologies. We didn't really get answers that were particularly helpful in terms of saying, well, this is the percentage impact on our portfolio, but we learnt a lot about what to do, what we needed to change, how we needed to improve methodologies, and who we needed to talk to for the data. Because in the TCFD pilot, everyone agreed we'd use the same models, so we're using an integrated assessment model called Remind, produced by the Potsdam Institute. And in that model, there's not a line that says this is what happens in the Australian economy. And we had to use OECD plus EU, and we are not like the OECD plus EU. So we understood and learnt about the methodology, but the results weren't really something that you could look at and go, yeah, that makes sense. So now we're in the process of looking at other alternatives and scenarios, including the IEA's scenarios, to understand where we can see Australia sitting in there. And the Remind model, one of the big things was working with the scientists to talk to them about the fact that Australia was absent. And they've been busily working over the last 12 months to put Australia in that model. And we're hoping soon that we will have our hands on that model. So that in TCFD phase 2, where there's now, we've gone from 30 to 36 or so banks, we're again experimenting with these tools. And I think having the collective of banks in there, we're all have exposure to different economies. We have different tools inside our banks. That's been incredibly useful as well to be able to share and bounce off each other. And this year, through that project, we'll get exposed to a greater range of the scenarios and tools that are out there. So it's a huge learning exercise. But in the meantime, what it has done is influence risk appetite, because we've learnt information, and that essentially the information is to guide decision making. So NAB came out early on after our heat mapping and said we will not lend to new thermal coal projects. Following some work we did on oil and gas, and the fact that I think we're fairly unique in Australia, and there's still not a lot of banks globally that have picked up on natural capital risks. It is absolutely part of our social impact strategy. We have a natural value strategy, we call it, as alongside our climate strategy. Those two things are absolutely tied in together. So biodiversity, and as a large bank for agriculture is being hugely impacted by the physical impacts of climate change. And having those two things working side by side is particularly helpful. So we then said, from oil and gas perspective, we will not lend to oil tar sands projects. And some people may say, oh, that, you know, there's no oil tar sands projects in Australia, but there are in the US. We are present in the US. And so it's a signal of what we will and won't do and why. And we also said we won't lend to projects in the Arctic refuge or similar Antarctic refuges, or projects that would impact on that. And there we're looking at the combination of stresses on the environment, both the climate impact of lending to the oil and gas projects and the actually preserving and conserving some absolutely pristine and important natural capital assets that we have. So that's kind of our story to date. It means that we've published things about methodologies, not results, but it has changed risk appetite and will continue to do so. Brian?
Thank you. I'm going to outline a process that's not that dissimilar to what Rosemary's just talked about, but I did want to start by saying, obviously from a credit rating agency perspective, our focus is on trying to understand the credit risk implications. We're not looking to exclude companies from being rated because they're not 2-degree compliant, for example. We have to just think about what are the pathways in front of us and how that might impact the credit profile of that entity over a period of time. So we're very focused on materiality to the ratings. So the first thing we did was about 4 years ago, a heat map exercise similar to what Rosemary described, where we identified the sectors that we believe are most exposed to transition risk and have now updated that heat map a second time last year. So we have 16 sectors globally that we see as having a significant exposure, and that allows us to zero in a lot of our resources and focus on those 16 sectors, which is about $3 trillion worth of rated debt that has ratings all the way from AAA down. So there's a significant franchise and reputation risk facing us about assessing these risks in a way that we capture properly in ratings. The next step was then, okay, that's great. So now you've got 16 sectors, several hundred companies, some of them rated AAA, several $1 trillion worth of rated debt. How are you going to figure out what that means for the rating? So we've been on a multi-year process to look at ways to integrate that into our rating processes. We started with creating a framework, a consistent framework on a forward-looking basis to think about how you'd assess this transition implications across all of the sectors. And we settled on essentially 3 transmission mechanisms, which were policy, regulatory, and changes in end market demand, predominantly consumer demand, and analysed what that meant for each of the sectors that were exposed. Internally published research on that, and we're learning from that. Well, that's giving us some insight into how you might start segmenting more to less exposed entities within those sectors that were being driven by the industry team, but also with some specialists that we're dedicated to this. And we got to that stage about 2 years ago, and then we realised actually it's really very hard to go from understanding how you might segment it by sector and by entity, but then creating something that is forward-looking, consistent globally, consistent across sectors, scalable, regularly monitored, and allows you to work within the constraints of the existing data and data providers that you have, right, the availability of data. So we went out and hired someone to help us develop a tool that would do that, who had been in this business for quite a long time in working at Carbon Tracker, actually. And so we've created a scoring tool that we believe is forward-looking, consistent across the sectors, and rank orders entities for their exposure to transition risk on 2 different scenarios. One is, equivalent to essentially an IEA NPS scenario, and the other is equivalent to a 2-degree scenario. And to do that, you obviously have to think about sector decarbonisation pathways. So it's not straightforward. So there's a generic framework that looks at existing exposure, near-term market regulatory, consumer preferences, risks they're facing, the near-term adoption they're taking to mitigate for that, and then looks at a 2-degree pathway and tries to assess how that would impact that sector and how this entity is or isn't adjusting for that. So that's taken us 2 years. We've published the framework. We've published a case study for autos. That auto scoring will become public in about 3 or 4 weeks. And then we're actively working on the other sectors that we will roll out during the course of the next 12 to 18 months. And the question is to echo Zoe on the earlier panel, well, so what, right? And what we're very focused on is making sure it's integrated in our rating committee. So it's compulsory now for the analysts to discuss transition risk for those 16 sectors in their rating committees and analyse what that might mean for the rating in the context of methodologies. And the tool we're delivering them will give them some guideposts for thinking about that, and also at a portfolio level, at my level and above, allows us to think about, well, hang on a second, this company's rated single A, that company's rated single A, one's got a score of 3, one's got a score of 7. Are we properly thinking about that in our ratings? And allow us to really take a much more structured, consistent approach to analysing the risks. So there's a lot of work that's gone into it. It's still not that visible, but it's going to become very visible in the very near future. And the scores are with the auto manufacturers, for example, right now, and the second iteration of those discussions are occurring, and they'll be published soon. And I think that will help people understand how we're working our way through these issues.
What we know from research and surveys that's been done, particularly in Australian contexts, by the likes of APRA and ASIC, is that there are different levels of understanding and sophistication around looking at climate risk and the different aspects of climate risk. I'm interested in the panel's view on, I guess, who's doing well, who's not doing so well, but what we need to ultimately bring the laggards, if you like, up to best practice. Perhaps, Brian, I don't know if you want to share what you're seeing across the different sectors about who's actually tackling climate risk and particularly transition risk well.
Well, I'd start by saying, echoing one of the plenary session comments today from the chair of Arabesque, which is my experience is that actually the issuers, the corporates themselves, are the most advanced. They have had to think about this for a long period of time. They can sense what's coming. They may not be disclosing a lot about it because it is confidential information, and it's difficult for them to say, we see this happening over the next 10 years and this is what we're going to do. They don't typically disclose that sort of information. But I see that sector predominantly most advanced in their thinking. Now, some of them are in different views as to what's going to happen. Right? Which scenario they pick is different. And you can talk to an auto manufacturer and they'll be very different in their views on this now than they were 3 years ago, for example. And you can talk to a power generation company and their views are dramatically different because that sector is decarbonising rapidly. But if you talk to the oil and gas sector, you're going to get very different, and we do get very different feedbacks. So I think the corporates are most advanced. I think the finance sector is accelerating and catching up. I think the regulators are catching up. You heard Jeff yesterday. We're all playing a bit of catch-up here, and we know we've got a big issue in front of us that's going to have significant implications. And one of the things the reason we created this tool was the analysts were uncomfortable talking to the issuers about it because they were basically they'd go and see the issuers, and then the issuer would wheel out someone who'd been thinking about transition risk for 10 years. And how do you engage with them around that, right? So that's my experience to date.
Rosemary, do you have any comments on that?
I think part of the reason why the finance sector is a bit slower is that we're not one sector. We're actually banking the economy, which means we have to do multiple sectors. And so if you're in the sector, you have deep understanding of your sector. And I think it varies across sectors. Like oil and gas, mining, energy, you've seen some really good examples from some companies who have absolutely engaged with it. You can have a good conversation with it. We've had some great engagement with customers. But then there's others who are clearly not thinking about it, and that actually sets alarm bells up in terms of risk management and their exposure to those risks. So I think it's many and varied, and you'll see lots more conversations happening. It's a core part of ESG risk assessment when we're looking at who we lend to now, understanding at a customer level what they're doing and how they're responding. Yes.
From a New Zealand perspective, obviously, you have different economic drivers, I guess, but what's the perspective from New Zealand?
Yeah, so if I talk about sectors, I'll talk about sort of asset class specific type of sectors. I think what we've observed, so one sector that we've really seen kind of expand and really take good opportunity from this whole transition is the renewable sector. So, the super funds always been active in trying to find good opportunities in the renewable space, but we've often struggled because the scale wasn't there. But more recently, in the past sort of 2 to 3 years, we've seen, some of these companies actually becoming a lot more efficient and providing scale to investors like us. So we're able to invest, especially in the wind side of things. The two sectors that I find is kind of behind or struggling or is faced with challenges, first is the timber sector in particular. So you might think timber is a really good investment. It is from a green perspective. But what we're struggling with within that sector is the fact that, in wanting to sort of account for some of the carbon credits and account for the carbon sink from that opportunity is difficult because the accounting rules sometimes don't allow for it. But on the other side, the accounting rules penalise you for when you harvest the timber. So, one of the solutions that I've researched and found out that you can, if you understand where your timber actually ends up from a life cycle perspective, so if it's been used for furniture versus whether it's been, shredded for pulp and paper, so there are differences in the way you can account for that. So we're trying to work within the sector to try to get a lot more transparency on the whole life cycle analysis. And then the other sector that's, I think, faced with a lot of challenges is obviously the agriculture sector. It's a really important sector for New Zealand. It contributes to more than half of our emissions, unfortunately, but it doesn't necessarily mean we turn our back away from that sector. And the government has this year kind of proposed that it's looking to include methane into our emissions trading scheme and include the sector in the emissions trading scheme. And I think in one way it's really positive, because it will give opportunity for the sector to start transitioning and thinking about what this actual cost implications are, and also giving opportunity to the farmers to think about how they can, if they decide not to retain being in the agricultural sector, then they can use that land and have land use change to other opportunities.
One of the things you just touched on was your emissions trading scheme, and obviously we have not yet got to the stage of putting in place an Australian trading scheme, notwithstanding various efforts in the past to do that. I'm interested perhaps to get your comments on how effective that's been in terms, you've had it in place I think for over 10 years now, how effective that's been in terms of starting that transition, and particularly across the sectoral approach, whether it's had, played a difference depending upon what sector you're covering. Yeah.
It's been really controversial. You're right, the ETS scheme has been in place for nearly about 9.5, 10 years now. And why it's been controversial, because agriculture was never part of it. So a lot of the industries that were participating always were, kind of had their backup, because, they're not the highest emitters, the agriculture sector is. So in that sense, it's been difficult. But now that the agriculture sector has been kind of earmarked that it will be included, I think things will get better. But one of the recent things I've learned and picked up from some of the conversations with the banks is the fact that at the moment, the way the New Zealand government has priced carbon, we're kind of sitting at about $25 New Zealand per tonne, and it's just not enough. There's some calls out within the industry that they need to raise the price of this, because it's not having enough behaviour change. And obviously when you're introducing policy like this, as we would have learned from this morning's conversation, it has been difficult. So you've always had to think about how you kind of, put the level, making a level playing field for all players. But the pass-through costs in terms of petrol and things hasn't really made such a big impact. So, this whole need to increase the price of carbon is probably something that's in the radar, but we're not sure how it's going to go. Yeah.
We know that there are quite a few drivers that have emerged in recent years in relation to, I guess, looking at the way the economy needs to transition. And one of the things we see from a legal perspective, and obviously have been highly influenced from, is the Hutley opinion, which I'm sure you'll all be familiar with, is really putting the emphasis on the need for engagement at a board level and the potential risk arising to directors from not properly assessing and considering climate risk. And another key driver and emerging, I guess, risk and threat is climate litigation, which we know is increasing at a rapid speed. Not so much, I guess, in an Australian context, but particularly in a US context. And I think it's probably only a matter of time before we see some of those trends in terms of litigation cases coming across into an Australian context. Rosemary, you touched on the fact that you do monitor climate litigation. I'm interested to know your perspective on how important some of these other, I guess, drivers are in terms of the bank's own thinking, but also those that you bank and, I guess, the corporate world more generally.
We see the litigation one as one to watch, partly because some of the cases are incredibly interesting in terms of their reach around, I guess, influence on companies' strategies, etc., but also on the costs. And you don't read many annual reports that actually put any provisions for this sort of litigation and for claims against companies where things go wrong. A lot of energy utilities have, even in Australia, quite considerable claims against them if their transmission lines are causing some of the fires that we see. We've seen one case of bankruptcy now as a result of that in North America. So actually looking at the different reasons for litigation and understanding that, and then actually looking back at the companies like in our portfolio and to see to what degree may they be exposed to this risk. And some of it does exist here in Australia, but some of these cases too will be landmark when they land some sort of verdict going forward. So you've seen, I guess, people raising cases around disclosure to get more information in the public domain, but we've seen cases around the causal impacts of climate change and whether companies can be held accountable for their contribution to that. If someone actually makes a decision around that, that will be incredible. But here in Australia, we've also seen at least challenges to project approvals and things like that. If those project approvals get held up, and those assets can't be developed, then it's not a great proposition to be lending to them if it's just money sitting there doing nothing. And it actually suggests that there's sort of asset stranding risk may be something that comes along behind that as well. So I think there's some interesting signals to watch there. So it's kind of a lead indicator to keep an eye on.
Perhaps before I open it up to the audience, just to flip now to the opportunity side and perhaps get the panel's perspectives on where the opportunities are in terms of what this transition looks like. I guess it's picking to some extent the winners of the future, low carbon economy versus the Kodaks or the losers. But the perspectives, perhaps if Brian, you'd want to pick off on where those opportunities sit from your perspective.
Yeah, I mean, I think the biggest opportunity is not being stuck with the Kodaks, right? And that's a very significant opportunity that in the fixed income market that people are rightly focused on, because you only get a limited return on fixed income. So the tool we've created has a score at the 1 or 2s, which is actually those who are going to benefit from the transition, who actually got a business model where they're taking advantage of it. That might be a Tesla, it might be a renewable power generator, it might be something else. And then the score goes on the way down, right? So I would say the way I think about it is we rate $3 trillion worth of debt. There's probably another 3 trillion of equity valuation, maybe a couple of trillion of bank. There's 10 trillion, right, out there where there's an opportunity not to be stuck with the Kodaks in that 10 trillion of debt. And I think that's a very significant... I don't think that's given enough emphasis yet. It is by the regulators, right? Mark Carney is saying that. I don't feel there's a sense of urgency about that yet in the way that there should be.
For us, it is about helping our customers transition. So whether it be the farmer who actually needs to be able to reduce his energy costs and move to a more sustainable and cheaper source of energy on farm and reduce their operational costs, or whether it's investing in renewables, and we've done that now since 2003, and that's been hugely valuable to the business and it continues to grow. Then there's new sectors, so all the sectors that support the new technology, batteries, some of the wind farm equipment that you see, all of that sort of... And Australia is uniquely placed to have those resources, and that was discussed yesterday. And I think in that transition too, it's to help our communities, even for the householder. You know, our building stock in Australia, the average house is still around 2-star. So, you know, how do we get change and how do we help that shift so people are more comfortable? If we get heat waves, we don't see people suffering from death due to heat wave. Thinking about what do we do to facilitate that transition and help customers right across the economy shift. And that means starting to engage in that conversation around just transition. If jobs and things shift, how do we help with that? What do we need to do as a financial institution that helps with the shift in our community?
Hardy?
Yeah, I probably just have a sort of a different perspective. As I think, you know, those industries that are faced with Scope 1 and Scope 2 emissions, I think, you know, we're seeing some change happening within those industries, but it's the ones that are exposed to high Scope 3 emissions. I think that's where we need to probably try to encourage a lot more transition to occur. But 2 industries in particular that, you know, in New Zealand and probably globally that I've seen that are trying to adapt to this whole transition move is obviously the automobiles sector. It's so good to see that, you know, that a lot of these different car manufacturers are now designing and producing, you know, hybrid and electric cars. And not only that they're able to do this, but actually a lot of this is now affordable. And 5 years ago, I'm not sure that it would have been. And I think 5 years going forward is going to get even better. So I think, you know, that sector has definitely picked up on this whole opportunity around transition. And the second is transportation. And I think this morning the panel alluded to it as well. You know, New Zealand is 80% renewables. So there's a huge opportunity within the transport sector, in particular in New Zealand, to use the grid and actually plug into the grid and electrify their fleet when it comes to buses and trains. So there's a bit of activity happening in that area, but I think, again, it's just a good opportunity for New Zealand to start transitioning, yeah.
Right, I'm going to open it up now to the audience.
Hi, my name is Sarah Clausen. I'm from New Forest, a sustainable forestry asset manager based here in Sydney. Do you want me to take that? You're all making enough way. Sorry. Thank you. Thanks. So my question, I fully appreciate your comments already about progress that needs to be made in carbon accounting, and there is a lot of work to be done there. We're already reporting to our investors on the carbon sequestration that they're getting through our funds. Al Gore once said the best vehicle for carbon sequestration is a tree. And I guess my general question to the panel is, how do you see land as part of the natural capital solution, natural climate solution for what we're trying to do here? So this is a panel about beyond energy, and forestry's been mentioned a bit yesterday and today, not as much as I would have hoped, but I guess this is a chance to talk about land, and whether that's forestry or agriculture, I just think land's an important part of that solution. Thank you.
I'd like to kick off.
Yeah, I'd probably just say I agree with you. And, you know, one of the things that the government in New Zealand has announced is the fact that it's pledged to plant 1 billion trees, and it's providing incentives to businesses and individuals to give up their land to be able to, you know, plant these trees. And, you know, and even with the agriculture, as I was alluding to before, with agriculture coming to the emissions trading scheme, there's opportunity for those farmers that if they're finding that the business is not profitable anymore, is to start changing their land use to making their land available to plant trees. So I think definitely it's a huge, it's an important asset, if you know what I mean, in terms of trying to get more trees being planted.
And I think it goes further than that too. If you're looking at farms, and that sort of links into our natural capital strategy, then essentially we know good farm management, good husbandry of the land, including soil and the biodiversity assets in the farm, can actually make a more productive farm. That means they're more profitable, that means they're exposed to less risk, they're more resilient in the face of climate change. So actually working with our agri customers and looking for the metrics that help them understand those relationships, because most people have done a lot of work with sort of, you've seen NGOs, science, the people who are concerned about conservation and agriculture doing all this work, but then it hasn't followed through to what that means at the financial end. So actually linking that good husbandry of the natural capital assets to the financial outcomes is going to help that. So we're spending a lot of time trying to actually do that and working with partners like CSIRO and others to actually look at what those indicators are. Then we can have the conversations, which we are with our clients, and hopefully we actually see a change. So you then start to see people understanding soil carbon better, biodiversity better, and the benefits that that can provide in mitigating and adapting to climate change.
And perhaps just a comment from our perspective. So we do a lot of work with those participating in the emissions reduction fund. So this is the Carbon Farming Initiative scheme that's been around now for a number of years. And it's fair to say that, unfortunately, that the scheme itself has stalled slightly because the money that was allocated by the federal government, the $2.55 billion, is running out, and so there hasn't been as much participation in that scheme recently. What we do know and need is kind of new types of methodologies or project types to kind of encourage activity on the land and at that farm level to ensure that projects continue to be developed. And ultimately, obviously, it would be good to have a buyer that wasn't just the government, but was also those who are looking to offset their emissions. But there is quite an active scheme in play already in Australia. It probably doesn't get the attention that it should do, but it sits there, as an opportunity as well to export eventually in terms of carbon offsetting.
This is a question probably more for Rosemary, but when you're working with your clients, as you say, if they're not, and it was sort of touched on with the fixed income as well, they're not trying to adapt, then it sort of sends up red flags, but it is also an opportunity to work with your customers. At what stage do you go, we've tried enough, they're not listening, we'll walk away? And I mean, it's similar to sort of the divestment argument in a way, but at what point does it just get, you sort of go, the risk is too great, you're not trying to change?
And I don't think we've got there yet. So I think actually understand the envelopes of the different scenarios. So knowing what a 1.5 trajectory looks like, knowing what that means, knowing what business as usual looks like, and looking for the levers. I think one of the big things that we've all got to do is look for those metrics that tell you when enough is enough. And then sometimes you will use that knowledge, but you will also, I guess, form a view on climate change and your contribution to addressing the issue that might actually flip a risk appetite switch quicker than that. So essentially, yeah, it could be both of those things, but absolutely you want to have conversations to at least encourage transition first.
Just going back a little bit to the previous point about agriculture, it seems to me that a lot of the focus, for obvious reasons, up to date has been on the energy sectors and perhaps now emerging the transport sectors. And clearly agriculture is a huge sector in terms of impact, transition risk, beyond climate change, but also biodiversity, land use and so forth. Perhaps it's just been less visible, what's been happening behind the scenes, the kind of things you were talking about, Rosemary. But I'd be interested to hear your views on what more the finance sector could be doing, should be doing, to actually lead and drive change in the agricultural sector.
I think NAB's pretty active in that area for agriculture because it's absolutely a key sector for us. We bank 1 in 3 farms in Australia. We also bank 1 in 4 farms in New Zealand. So it's a key sector for us to think about. And so we've been on this natural capital journey, particularly focused on agribusiness, since 2011, where we signed what was called the Natural Capital Declaration, which is the beginning of a journey within the global financial sector to address and understand natural capital risks. That's now, you still, if you become a member of what's called the Natural Capital Finance Alliance, sign the declaration, but it's now changed its name to the Natural Capital Finance Alliance. And I think there's evolving tools both for corporates and for finance to help people understand natural capital and natural capital risks. I think traditionally what we've done is focus on the impacts. And that's what all our environmental legislation does. It's focused on essentially the impacts we cause on and contribute in terms of damaging or degrading natural capital. What's interesting in the Natural Capital Protocol, if you have a look at it, and there's a supplement for financial institutions to help financial institutions think through that risk. So it's been published by the Natural Capital Coalition, another international group, and they actually start thinking about dependencies. So if you then turn it around and you don't just think about how you impact nature, but how you depend on it, you get a whole different risk profile there. Because if you do the wrong things and you actually damage those assets, then suddenly you can't get the inputs that you need to your business. And I can see Marty sitting at the back. The CDSB also has a framework for how you can disclose on this. I think we're a long way behind carbon when it comes to natural capital risks, and we've still got a huge education piece to do within the financial sector to understand that. But a range of companies in the corporate world have absolutely understood that. We think it's really important, which is why, you know, our CFO in 2011 came back from an event where Stern and others were. It was a Nobel Laureate Symposium in the UK, and he came back going, "This biodiversity stuff." He said, "I thought I was going to hear about carbon when I was going to listen to Stern," and Prince Charles was hosting it. He said, "It's actually the canary in the coal mine." And it is what contributes to the quality of our life on planet. So we actually need to understand the linkages between natural capital and climate risk, but natural capital in its own right as well. And so it's definitely at the Unipify roundtable that was held in last year. What was really interesting is after everyone was talking about TCFD and a whole heap of other developments in the financial sector, and sorry, if people don't know, UNEPIFI is the United Nations Environment Programme Finance Initiative. A bunch of CEOs on the panel who had been talking about kind of evolving risks said the next wave of serious risk that the finance sector must get their head around is natural capital risk. So it's coming.
Yeah, maybe I can add one thing from a macro perspective as well. To echo that, the assessment of the impact of natural capital on the economies of states, sovereigns, is something that we're spending quite a bit of time on, because it will change structures if it's not properly mitigated. We've published on that in the context of the Australian states already. So I think that's a big component of what will be coming, because the public finance market's a massive asset class, and they will become increasingly concerned about not just the impacts of climate hazards, which is a big focus at the moment, but the climate trends and what that will how that will change economies.
And I think a real sleeper is water. I think, you know, we talk a lot about carbon, but water is going to be a huge problem moving forward. Just perhaps one comment, I think the challenge in terms of the ag sector, land sector, is really making it scalable to get the investment flow. The problem at the moment is it's quite small. You don't have the volume or the aggregation that we need to really start getting serious investment flow into that space. So that is obviously something that will need to change.
Hi, thanks. Lisa McDonald from First State Super. I've just got a question for Artie, if that's okay. I just want to make sure I got your comments at the start in terms of how you're looking at carbon across the portfolio, and it was around reducing high-intensive companies and trying to identify companies that are transitioning. Mm-hmm. I've just got a couple of questions around that. In terms of identifying high-intensive companies, do you have a taxonomy or sort of metrics in place to identify what they are? And then what sort of taxonomy or metrics are you using to identify companies transitioning? And is that being done through your analysts in the portfolio, or are you relying on external data? And then from that, if you're doing that, are you changing any of your benchmarks with managers?
Wow, okay.
I've got lots more, but
how long have you got?
Stay with that.
Right. So, yes. What we did was we developed our own in-house methodology to identify those companies that were sort of the high emitters from a carbon intensity perspective, and also identify companies that own fossil fuel reserves. So those two were kind of very standard metrics. And then the third aspect of it was to then look into those companies that are part of that transition. So they still might be high emitters, but are part of the transition. And to decide on which categories all these companies sat in we have used and relied on external provider. So we've used their data, which is MSCI's data, and that has been integrated across the portfolio. And then to ensure that we are prudent in the way we've done that, we've actually did change our benchmark and made it our own custom benchmark, which was, you could say it's low carbon, but we don't like to refer to it as a sort of a carbon benchmark, because our whole climate change strategy was around reduction and not purely saying that we have excluded various sectors out of the portfolio. So does that kind of, I've tried to sort of make it short, but we can catch up on that if you want to get into the details. Yeah.
One final question.
Hi everyone, Veronica Dorr from CSIRO. It strikes me, I'm going to try to draw together a little bit of what we've heard here, that there's probably a series of waves of economic transition that we need here. And we started out by hearing about effectively the mitigation driver for those. And then we went into natural capital accounting and how there might be a kind of wave that's a ways behind, say, in terms of transitioning out of the sorts of industries that are really damaging to our natural capital. But I do think water sits in that middle space, and particularly in Australia, where arguably there should be just as much, if not more, of an adaptation driver for transition. And what that might look like is not necessarily just building the companies that generate water, right? But actually working on the demand side as well as the supply side. And what are the new types of technologies and companies that we should be investing in that use less water to begin with? Is that part of the transition thinking yet, or is it still some ways behind like natural capital is?
Hello, Veronica. Good to see you. So I would say from our perspective, it is one of those that's on the list of to-dos and increasingly coming up. And we focused on a lot of time on transition. Now we're in physical risk. We made an investment in 427 that is going to help us accelerate our thinking around that. Water, yes, absolutely very significant issue that I think is, I agree, I don't think it's a sleeper anymore. It's becoming more and more relevant. I mean, just to give you one example, I was at a seminar in Melbourne earlier in the year, and the chairman of Melbourne Water said, well, they're running certain scenarios now about what might happen from demand and supply for water. They think that they probably need a desalination plant, a second desalination plant to be built. It's only a question of which year they pick, right? So we don't rate the city of Melbourne, but that's a significant capital expenditure issue for them that they need to manage. So I think these things are coming to the fore. There's a lot of research being written about something called waternomics in Asia, which is, for example, China is not going to be able to expand and grow at the way it wants to because of water issues. So it's going to have to, and it is addressing its water issues. So I think it's a very significant issue, but I don't feel like at least we're where we need to be, and I don't feel like when I walk into a room in the finance sector there's a lot of people who are there yet.
I think it is being considered, but there's a lot more thinking to be done. We would put it into the natural capital bucket, but if you're looking at physical risk, then there's a whole range of sectors that are subject to that physical risk which relates to water, and either too much or not enough of it. So water scarcity is absolutely a critical issue for Australia, and it's something that is in our ESG assessments when we're looking at our customers, and we're wanting to know, particularly if they're a water-dependent company, what's their security of supply looking at? Like, have they done a water risk assessment as part of looking at the physical climate risks? Even in some of our energy utilities, if we have material drought, look what happened in Tasmania with the hydro power. Basically, we didn't have some of the hydropower that we needed in the Millennium Drought. So we absolutely are at risk because of water supply. And, the shortage of water is a critical risk that we have to all get our heads around. It could strand some assets going forward in the future, and it will definitely make some investments more risky.
Well, one of the objectives of this session was to go beyond just the normal discussion around energy and electricity market and to touch on some of those other economic areas where the transition will be required. So I hope we've managed to do that for you. I think we've touched on ag, transport, built environment, which are 3 critical sectors in an Australian context, and also hearing about the forestry and the ag sector from a New Zealand context. We're between you and lunch, so I'm going to finish now. If you could all thank the panellists for their involvement.